Welcome to our new series aimed at helping beginner traders navigate the world of Forex trading. Embarking on this journey can be daunting, but don't worry. We're here to guide you every step of the way. It all begins with understanding the basics, the ABCs of the Forex world. In this series, we'll unravel the mysteries of the foreign exchange market, currency pairs, and even the art of reading a currency pair. Our first topic: the foreign exchange market and currency pairs, the very foundation of Forex trading. So, what exactly is the foreign exchange market, or Forex as it's more commonly known? Picture a bustling global marketplace where buyers and sellers from every corner of the world come together. But instead of goods or commodities, they're trading currencies. That's the Forex market for you. It's like the financial equivalent of a never-ending global fair. And it's not just for big banks or financial institutions. Anyone can participate, from multinational corporations to individual investors sitting at home in their pajamas. The Forex market is unique because it operates 24 hours a day, 5 days a week. That's right, it never sleeps. This is because as one major global market closes, another one opens. So, when traders in Tokyo are calling it a day, their counterparts in London are just having their first cup of coffee. This round-the-clock action makes Forex the most active financial market in the world. But what's at the heart of all this activity? It's the simple act of exchanging one currency for another. Whether it's dollars for yen, euros for pounds, or any other combination, the Forex market is all about currency exchange. You might wonder why it's important to exchange currencies. Well, think about it. If you're a Japanese company that wants to buy an American product, you can't pay in yen, can you? You'd need to exchange your yen for dollars. And that's where the Forex market comes in. The sheer volume of these transactions is staggering. To give you an idea, the average daily turnover in the Forex market is over $5 trillion. That's more than the annual economic output of most countries. This vast and vibrant marketplace operates on the principle of supply and demand. The value of a currency can rise or fall based on a myriad of factors, from economic indicators and geopolitical events to market sentiment. And it's these fluctuations that Forex traders aim to capitalize on. So whether you're a seasoned trader or a curious beginner, the Forex market offers a world of opportunities. But remember, with great opportunity comes great responsibility. It's crucial to understand the basics before you dive in. Forex trading revolves around currency pairs, but what does that mean? Well, stay tuned and we'll delve into that in the next scene. In Forex trading, currencies are always traded in pairs. This is a fundamental principle that forms the basis of every transaction in the Forex market. But what does it really mean? Imagine you're at a foreign exchange booth at an airport. You hand over your dollars to get euros because you're heading to Paris for a vacation. This is a simple example of a currency pair transaction. You've sold one currency, the US dollar, to buy another, the euro. In Forex terms, this would be represented as EUR/USD. Now, in every currency pair, there are two parts. The first currency listed is called the base currency. This is the currency you believe will strengthen or weaken against the second currency, which we call the quote currency. So in the EUR/USD pair, the euro is the base currency, and the US dollar is the quote currency. Let's delve a bit deeper into this. If you think the euro will strengthen against the dollar, you would buy the EUR/USD pair. Conversely, if you believe the euro will weaken against the dollar, you would sell the EUR/USD pair. Here's another example to help illustrate this. Let's say you're looking at the currency pair USD/JPY, which represents the US dollar against the Japanese yen. If you expect the dollar to strengthen against the yen, you would buy this pair. But if you expect the dollar to weaken, you would sell the pair. In essence, when you're trading currency pairs, you're speculating on the relative strengths and weaknesses of two different currencies. It's a game of comparison where you're always evaluating one currency against another. This is the beauty of Forex trading. It's not just about single currencies in isolation. It's about pairs, about relationships, about the ebb and flow of the global economy, reflected in the relative values of different currencies. Not all currency pairs are created equal, though. Let's break them down. Currency pairs fall into three categories: major, minor, and exotic. Let's unpack these terms to understand what they mean and why they are important for Forex traders. Major currency pairs are the ones that are traded most frequently. They usually involve the United States dollar, which is the world's primary reserve currency. The other half of the pair is typically another high-powered currency like the euro, the British pound, or the Japanese yen. There are 7 such pairs, and they account for roughly 80% of global Forex trading volume. The high liquidity of these pairs means they often have the tightest spreads and abundant market availability. Then we have minor pairs, also known as cross-currency pairs. These pairs do not involve the US dollar. Instead, they're made up of the major currencies outside of the US, like the euro, the British pound, and the Japanese yen. Minor pairs are less liquid than major pairs, but they still have relatively tight spreads. Last, but certainly not least, we have exotic pairs. These involve a major currency and a currency from a smaller or emerging economy like South Africa, Turkey, or Mexico. Exotic pairs are less liquid and have wider spreads. They can be a bit more unpredictable, but they also offer potential for significant profits if you can navigate their unique risks and challenges. In summary, major pairs are the most traded and have the highest liquidity. Minor pairs exclude the US dollar but still involve major currencies, and exotic pairs include a major currency and a currency from a smaller or emerging economy. Each type of pair has its own set of dynamics and requires different strategies to trade successfully. Now that we understand the types of currency pairs, we need to learn how to read them. Reading a currency pair may seem complex at first, but it becomes second nature with a bit of practice. Let's break it down. When you look at a currency pair, you'll see 2 prices. The first is the bid price, and the second is the ask price. The bid price is how much of the quote currency you'll need to buy 1 unit of the base currency. On the flip side, the ask price is how much of the quote currency you'll receive when you sell 1 unit of the base currency. Let's illustrate this with an example. Suppose we have the currency pair EUR/USD with a bid price of 1.1 and an ask price of 1.15. This means that you can buy 1 euro for 1.1 US dollars, or you can sell 1 euro and receive 1.15 US dollars. Now, you might be wondering about the difference between these 2 prices. Well, this is known as the spread. The spread is essentially the cost of trading. It's the difference between the buying price and the selling price. So in our example, the spread would be the ask price of 1.15 minus the bid price of 1.1, which equals 0.05. Understanding these prices is crucial for making strategic trading decisions. The bid and ask prices tell you about the supply and demand of a currency pair in the market. If the bid price is rising, it means the demand for the base currency is increasing. If the ask price is falling, it suggests the supply of the base currency is increasing. It's also worth noting that the spread can be a good indicator of market volatility. Generally, a wider spread suggests higher volatility and higher trading costs. So there you have it. Reading a currency pair is all about understanding the bid and ask prices and what they signify in the market. With these basics under your belt, you're well on your way to understanding Forex trading. We've covered a lot today, so let's recap. We embarked on a journey to understand the alluring world of Forex trading, beginning with the basics. We learned that the Forex market is a global platform where currencies are exchanged, a market that never sleeps, operating 24 hours a day, 5 days a week. We then moved on to the concept of currency pairs, the heart and soul of Forex trading. We discovered that a currency pair consists of a base currency and a quote currency, and that the exchange rate tells us how much of the quote currency we would need to buy 1 unit of the base currency. We also delved into the different types of currency pairs, major, minor, and exotic. We learned that major pairs involve the most traded currencies worldwide, minor pairs exclude the US dollar, and exotic pairs involve a major currency and a currency from a developing economy. And finally, we touched upon how to read a currency pair, including the bid and ask prices, and how crucial understanding these prices is in making informed trading decisions. We hope this information has provided a solid foundation for your foray into Forex trading. But hold on, we're just scratching the surface. In our next video, we'll dive deeper into the world of Forex trading, exploring the concept of pips. Stay tuned!